It will be fair to say that in recent times, particularly over the past week, market activity has been exceptionally eventful. We saw major central bank rate decisions, inflation releases, labor market reports, and PMI data. Every trading day had at least two market-moving catalysts. Some of the resulting market moves may have left traders wishing they were ambidextrous, yet, amid the volatility, certain price movements aligned cleanly with underlying economic fundamentals, while others defied interpretation even for the most seasoned analysts. If you were actively engaged in the market as I was, whether the market handed you lemons or lemonade, there's no need to dwell on it. Market outcomes are often a reflection of one's current stage of development as a trader. As many experienced market participants consistently emphasize, risk management remains the closest thing to a true holy grail in trading. It is one element that must never be neglected. Welcome to another edition of Market Pulse Weekly, your source for actionable market intelligence. We help traders and investors cut through the noise, understand what truly moved the market, and build clarity, discipline, and a structured path towards consistent profitability. Before we unpack the lessons in this video, listen to the disclaimer or read as displayed.
The information provided in this material by Renaissance Capital is intended solely for educational and informational purposes. It does not constitute financial advice, investment recommendations, or an offer to trade any financial instrument. Trading in Forex, CFDs, and other leveraged products involves a high degree of risk. You may lose part or all of your capital, and you should never trade with money you cannot afford to lose. While every effort has been made to ensure the accuracy of the information contained herein, Renaissance Capital assumes no responsibility or liability for any financial losses or damages resulting from the use or misuse of this material. Readers are strongly encouraged to seek independent financial or professional advice before engaging in trading or investment activities.
Next, we quickly take a look at our trading methodology. As you know, we trade using fundamental analysis first, then we move to our technical analysis where we combine our top-down analysis with the weekly rate. Then we also utilize the sentimental analysis to guide our trading, but we trade using price action. From sentimental analysis, because we look whether it is a risk on or a risk off market, or are we in a mixed market. Our technical analysis involves looking out through all the time frames, quarterly, monthly, weekly, daily, 4 hours, 15 minutes, find to really understand what trend is on the higher time frame. Then we look to follow the same on the lower time frame. Our entry time frame, as I said earlier, is usually 15 minutes. Early in the week, market reacted to comments from Kevin Hassett, the potential next Federal Reserve chair. Hassett sought to reassure investors that Federal Reserve will remain independent and non-politicized, despite concerns surrounding his nomination by former president and his well-known policy views. While questions around central bank independence surfaced, market largely dismissed the commentary as non-actionable from a monetary policy standpoint. The implication of this information is that dollar remained largely unchanged as investors focused instead on data that directly impact rate expectation. Next, we had data from Canada. Soft Canadian inflation reduces hike expectation, pressuring the loonie. Canada released lower than expected inflation data. Canada released lower than expected inflation data as reflected in the trimmed mean CPI for November, reinforcing the narrative of easing price pressure. The implication of this was that the Canadian dollar weakened as the probability of a further rate hike declined marginally. The next data we had came from Japan. Trump Tankan survey lifted the yen as BOJ hike expectation rise. In Japan, the yen strengthened following a better than expected Tankan survey alongside constructive comments from the Bank of Japan, which increased market confidence around policy normalization. The implication of this for the JPY is that markets will price higher odds of a BOJ rate hike, supporting the yen early in the week. Next, we had data from UK. Mixed UK labour data keeps pressure on the sterling despite PMI rebound. UK labour market data showed a slight increase in unemployment rate. However, the pound briefly rebounded after UK PMIs highlighted persistent labor market tightness. UK labor market data showed up a slight increase in unemployment rate. However, the pound briefly rebounded after UK PMIs highlighted persistent labor market tightness and renewed price pressures, prompting a modest repricing of a rate cut. Priced in for 2026 from 64 basis points down to 56 basis points. The implication of this was that despite short-time volatility, the pound weakened overall. Next, we had data from the Eurozone. Eurozone PMI disappointment failed to shift the Euro Central Bank policy outlook. PMI data surprised to the downside, reinforcing concerns around weak growth momentum. However, the miss was not significant enough to prompt immediate policy action from the ECB. The implication of this was that the market reaction was muted with limited impact on the ECB expectation. So the euro didn't gain strength, neither did it weaken. The next data we had came from the US. We had a higher US unemployment rate briefly weakened dollar amid volatile NFP release. US non-farm payroll were unusual this month. This time around it combined October and November job gains, while the unemployment rates reflected November only. The unemployment rate came in higher than expected, drawing the most attention and prompting sharp repricing of March rate cut expectation from 48 basis points up to 58 basis points. The implication of this was that the dollar weakened initially, but the move quickly faded amid equity sell-offs and year-end flow distortions. Next, we had data coming from UK. We had a soft UK inflation, which reinforced the dovish Bank of England outlook and pressured the sterling. That was on Wednesday. The UK reported a softer CPI print, which weighed on the pound but supported UK equities. Prior to this week, the Bank of England was already expecting to cut rates by 25 basis points. After both weak employment and CPI data earlier, market now expect the cut to be delivered alongside more dovish forward guidance. The implication of this was that after the data, we had a weaker pound. Next, we had data coming from Euro. Euro slips as slow growth overshadows progress on inflation. Eurozone inflation also undershot expectations slightly, while inflation is close to the ECB's 2% target. Growth remains sluggish, and the Euro Central Bank officials have repeatedly emphasized that only a material deviation would prompt action. So, because of this data, the euro weakened modestly, reflecting growth concerns rather than inflation release. The implication of this data on the strength of the euro was that it weakened modestly, reflecting growth concerns rather than inflation belief. Next, we had a realtor, rumor that came into the market. China computer chips breakthrough weighs on US tech stocks. Reports from Reuters suggest that China may have made faster than expected progress in domestic semiconductor production, potentially achieving advanced chip capability ahead of 2028. If accurate, this would reduce US leverage in AI-related technology restrictions and signal a strategic shift following last year's export ban. The implication of this information on the US stock was that US equities softened, particularly in the tech sector, as was noticed in the Nasdaq. At the second half of the week, we had a central bank rate decision from England. The BOE delivers hawkish cost, lifting sterling on tighter forward guidance. The Bank of England cut rates by 25 basis points, lowering the policy rate to 3.75% from 4%, as widely expected. However, the market reaction was hawkish. The MPC guidance suggested that the Bank of England is near the end of its easing cycle. Officials warned of a potential December inflation uptick and a limited room for cuts in 2026, pushing the next expected cut from April to June 18, 2026. The implication of this on the pound was that we noticed that it strengthened sharply. We also had central bank rate decision, and ECB steady policy stance supports euro amid firmer inflation figures. The Eurozone reported slightly higher inflation while ECB left rates unchanged. Current market pricing suggests rates may remain on hold throughout 2026. During the press conference, President Lagarde reiterated a data-dependent approach, offering no urgency towards easing. The implication of this on the euro was that it strengthened modestly. Next, we had data from Japan. The headline here says that BOJ rate hike triggers sell the fact reaction as yen tumbles. The Bank of Japan raised rates by 25 basis points, bringing its short-term policy rate to 0.75%, which is the highest since 1995. Despite that the hike was fully anticipated, markets reacted with a classic buy the rumors, sell the facts response. Analysts largely attributed the yen's weakness to the high bar for additional hikes in first quarter of 2026, with policymakers signaling that only strong spring wage negotiation would justify further tightening. The implication of this on yen was that it weakened sharply, prompting verbal intervention attempts from Japan Ministry of Finance, which failed to stabilize the currency. On Friday, next we had data coming from Canada. Soft Canadian retail sales leaves loonie lagging into week's end trading. Canadian retail sales came in weaker than expected, reinforcing concerns around domestic demand. The implication on this on the Canadian dollar was that it finished the week among the weakest performance. Looking ahead, the only major market moving data expected this week is the US initial jobless claim, with the Federal Reserve closely monitoring labor market conditions. This release, the final labor data of the year, could materially influence net-term rate expectations. A higher than expected reading would increase the probability of a rate cut at the next FOMC meeting, while a lower print would likely reduce those odds. US jobless claims sets to shape final Fed expectation of the year. Next, we take a look at what could drive price this week. Let's quickly look through our upcoming economic calendar. Looking ahead, the only major market moving data expected this week is the US initial jobless claim, with the Federal Reserve closely monitoring labor market conditions. This release, the final labor data of the year, could materially influence net-term rate expectation. A higher than expected reading would increase the probability of a rate cut at the next FOMC meeting, while a lower print would likely reduce these odds. So, US jobless claim set to shape final Fed expectation of the year. We will also be paying close attention to key economic figures and comments from central bank speakers this week. On Monday, we have a empty data docket. So the only important data we are looking at this week should be the Canadian GDP and the US preliminary GDP. Above all that, I am more concerned about the US unemployment claims that is coming in on Wednesday. We can see already that the last one was so whether it comes in higher or lower, we would know what to do. And on Thursday we have the BG governor Ueda would be giving us form of our guide on how to what to do with the JPY in the coming week or in the new year. Next, we look at currencies we plan to buy and currency pairs we plan to sell. Clearly, highlighted the currencies I'm interested in buying on the left-hand side, while on the right-hand side, I have, highlighted currency pairs I'm interested in selling. Next, we move into our charts to do a thorough technical analysis of the currencies, of these currency pairs. So for dollar on the quarterly time frame, we are still within this high and this low from there. And from this low, we had seen price constantly show a bullish trend, as you can see. So from this high, price has, from this low and this high, price has been sideways from there on. That neither break this high nor break this low. So this is where we are currently. Last quarter of the year, we have seen some form of low volatility. Price is still here. So on the monthly time frame, price has been bearish since the odds of a rate cut became higher, sometime since November, and where we are currently, you can see price has been weak on the weekly time frame. After taking out the high here, price has moved downward. Our next target could be 97, let's say 98. Then there's maybe past it gets displaced. The liquidity sitting here being run out and this fair value gap being closed in. So depending on data, so long as we continue to see data that support a rate cut, I believe that dollar will continue to weaken in 2026. The only thing that could make dollar rally is if we get the probability of a rate cut cut down. We'll see some form of hawkishness, or we receive a form of a hawkish comment from the central bank governors or sorts of data like that. Or maybe we get a higher CPI reading. Maybe we begin to see a strong labor market, and we begin to see higher inflation. When such data comes up, then we may begin to see strength in the dollars. But so long we don't see such data coming to the market, we expect that dollar will continue to be weak. That already started, becoming bearish from this high and where we are currently. So I think this high will be taken out easily. This low will be taken out easily. The next target could be this 97.50. Then we could come all the way here to fill the fair value gap here. And, depending on data that come into the market. Next, we'll look at the USD JPY from the quarterly time frame. We can see market has been strong. It has been bullish after coming back into this zone. There's demand zone and brand higher that failed to break this high first half of the year. We are seeing a weak dollar and running high at the current moment, because we have continued to see reasons to believe that the Federal Reserve will continue to cut rates. We are seeing some form of hesitation in dollar, breaking this high. So this is the monthly time frame. We are still majorly bullish here. The weekly time frame, we were bullish last week. Upper week, yes, last week mostly. This high was not broken. This high wasn't broken either, and here we are. We have mostly been bullish because of the weakness of the yen mostly. Despite that, the dollar had been, being weak most recently. But as you can see from the charts, Japanese yen has been weaker than the dollar. We have seen a yen that is weaker than the dollar. You can see it is clear in the charts here. So on the weekly time frame, mostly sideways. Price had neither break this high, this low had not been taken out. We have clean equal lows here, and we have formed clear equal highs there. On the daily time frame, this is Monday's price, not last week's price. Let's see, this is the rally on Friday after the BOJ eventually hiked rates as expected. And however, because the 25 basis points hike was already priced in, we had seen the barrier to a next rate hike was became higher, and sort of because the current government might want to resist any form of rate hike in the near term for the Japanese economy. Next, we are also interested in buying USD CAD in the quarterly time frame. This is this high here and this low from there. So price has been around this place majorly. It has been ranging on the monthly time frame. I did mean that we'll continue to see the probability of a rate hike increase. I believe that by this time dollar would have come as high as this place, and our target would have been this area 1.450 there, about 1 point. Our target would have been this level, this 1.5000 would have been our target. But since the dollar began to weaken due to an increase in rate cuts, it's in a weakened dollar. That's why we are noticing more that CAD had been stronger than the US dollar, and you can see it had weakened and continue to go downward. Perhaps our next target will be this area 1.36 there, about this level. We'll wait to see. We just have to wait for data that can catalyze the movement downward or upward. But as it stands, we are most likely going to continue to see a weakened dollar. And it's not necessarily that the CAD is actually strong, it's just that the dollar is very weak right now. And we have been told the reason why we are experiencing that. On the daily time frame, you can see trading for USD CAD last week was weak. It is Friday's price, Thursday, Wednesday, Tuesday, and Monday. You can see it's basically sideways. So from the weekly time frame, we might most likely continue to see weakness coming to the dollar, and the reason is that the probability of rate cut is currently high. The next pair that we are interested in buying is the Australian dollar JPY. As usual, we move from the quarterly time frame. We have seen some form of strong reaction from this level all the way to this point. That's a lot of thousands of pips right there. So we are aiming for this level. Should we continue to see probability for a cut in Japan or a hold coming to the market against the current hike that we had last week? So we'll continue to look for a buy quarterly time frame, and the quarterly time frame on the monthly time frame is also we're also looking to buy. We are not looking to take any form of sell as far as I'm concerned for this trade. So on the monthly time frame, I've seen some form of strong bullishness. When was this low formed? April this year. Price has continued to move higher this from the low formed in April. Price has continued to move higher. The weekly time frame, same story, bullish. Last week we had a bullish candle. This week we are most likely going to have the same. On the daily time frame, look at this Friday's price, Thursday, Wednesday, Tuesday, Monday. You see the first 2 days of the week before the low of the week was formed on Wednesday, because it was bearish Monday, bearish Tuesday. But from Wednesday we had a bullish, strong buy interest that eventually took out the previous high formed there. So we're only looking to buy this, guys. We're only looking to buy AUD against the JPY next. The next pair we're interested in buying is the CAD JPY quarterly time frame. From this low formed here, that's the second quarter of the year, we are seeing a strong buy interest here, and our target is this 120 thereabouts. Then the next target will be 125.70. Should we continue to see a strong card in terms of labor markets and inflation, and we continue to see the order of a rate hike in Japanese reduce or lower, would continue to facilitate our buying here. Same buying. We are not interested in taking a sell trade here. We are interested in just buying on the weekly time frame. You can see, continue to buy. You can see this Friday's price, Thursday, Wednesday, Tuesday, Monday. So we are only interested in buying this pair. And perhaps after this fair value gap is tapped into this fair value gap. So we had set an alert. Once price close this fair value gap from there, we would look for a buy. We should also take cognizance that we are in the end of the year, and pricing tends to not be easy to pin down price at this current time of the year. We'll be waiting to see what's the reaction at this level. Next, we move to the Euro card. From the quarterly time frame, you can see price are taking the liquidity sitting here. Although we are interested in buying this pair, we can see from form of hesitation after taking the liquidity sitting here. So on the monthly time frame, notice some form of hesitation to go higher, and market is kind of trapped within this level. It's basically been ranging for some weeks now, and we should also pay attention to see that that liquidity is kind of low here. Got the band here kind of tight, meaning that really don't have a lot of it just really means that there's no lack of interest in this pair generally from large scale investors, because market has just been sideways from this high from there. I think this is the next low, the lowest low and the lowest high, and price had been sideways. So in most cases the price movement here will be kind of very, very, very small, muted movements, sideways movements from here. So you guys should watch out for this kind of you guys should not be surprised when you see this for the Euro card. But we are majorly looking at data to buy out bets. Though we are from our trading plan, we are mostly positioned for a buy and a sell. We are mostly positioned for buying euro and selling CAD. We might not really be trading this pair, to be honest. On the daily time frame, price had been, bullish, sideways all the way here. Price had broken this low. Price, there's really we might just be, hands off for this pair for some weeks to just see a break to the upside or a break to the downside. We'll get to know. It's clearer here. Look at this low. Look at this high. Price had not broken this high, neither has it broken this. So we are majorly sideways. So we'll be careful to trade this pair. Next, for pairs that we are properly positioned to sell. Clearly, the Great Britain pounds had been bearish for many years. You can see on the quarterly time frame. This is first quarter, second quarter, third quarter, fourth quarter that have been mostly bearish this year. We are only interested in selling this pair, obviously. That on the weekly time frame, we can see that price had retraced here. So we might see a continuation since the close of this bearish weekly since the close of this bearish weekly candle. So we might continue to see a continuation of this sell. And that's how we are mostly positioned for this pair. We are mostly looking for opportunity to sell, the Great Britain pounds and buy the CHF. However, we also wait to see if we get data that supports our intention to sell this pair for mostly the Swiss National Bank. And lastly, for pairs that we are looking forward to sell, we are looking at a UD card, a sell of the Australian dollar and buying of the Canadian dollar. You can see a clear bearish trade here on the quarterly time frame. On the monthly time frame, you can see a clear case of bearishness. And when we look closely at the weekly time frame, we can see we have a range from this low here. After taking out the low sitting here, price also cleared out the liquidity sitting here. So we have kind of from that time we have kind of come back into the the discount zone, and we might continue to see a push upward. However, we are only interested in selling this pair, depending on data. A weekend, especially when we get a weak labor data or a weak inflation data in Australian dollar, and in the Canadian economy we are getting a stronger labor data and a stronger inflation data. So that would kind of support our intention to sell this pair. Our first target might be 90.50 there, 90.58 thereabouts, and downward. You never know. So that is it, guys, for our projection for these pairs. So guys, that is how we are positioned for those pairs, especially for pairs we are interested in buying and for the pairs we are interested in selling from a technical analysis standpoint. So that is it, guys. Thank you for sticking around. Thank you for watching the video to the end. If you have a question, do not hesitate to leave a comment. Please subscribe to the channel, share the video with your community, give us a like, and leave a comment, and subscribe to the channel. Hit the notification button so you would know when the next video is released. Thank you, guys. I wish you good trading week.